Hello, everyone. Welcome to Deloitte's Debriefs webcast series in Asia Pacific. Our webcast today is from our Real Estate Tax Geography Updates series, Australia's new thin capitalization rules, implications for real estate investment. Today, we have an outstanding sign up of 700 or so from countries near and far. A very good day to you. My name is Clan Yo. I'm a financial services tax partner based in Deloitte, Singapore, and I'm delighted to host you today. We have along with us two presenters, Silky Chen and Max Pearson. Silky is a tax partner in Deloitte, Australia, and is Asia Pacific's regional tax and legal leader for investment management. Max is the real estate tax leader of Deloitte, Australia. You may access our bios on the left side of the screen. Before I introduce the agenda for today's webcast, I would like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have content-related questions, you can submit at any time in the Q&A box at the bottom right of your screen. We'll do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, mobile device users can view the slides and answer the survey on screen. Thirdly, if you require an attendance record for this event, you'll receive an automated email with CPE certificate after watching for 15 minutes or so. Now, let me give you an overview of the topics we will discuss. So I cannot see the presentation on my screen. Can you just confirm to me that it is presented? Thank you, Tom. So today's agenda will follow as such. We will start with interest limitation rules, the overview, practical examples, fixed ratio rules, third party debt test, conduit financial modification, followed by debt deduction creation rules, and we'll end off with questions and answers. Let's kick off the session with a polling question. And the question is, how prepared is your organization for the new interest limitation rules? Are you completely ready? Bring it on? Or assessed impacts and implementing responses? Or currently assessing impacts? Or trying to understand the rules? Whilst we wait for the results to come in the next minute or so, let me turn the question to Silky and Max and your market observation. Where do you think your clients are at in terms of how ready are they with the new thin capitalization rules, Silky and Max?
I think it depends to some extent on when the rules apply for each taxpayer. So for 30 June taxpayers, there's already 1 year of the rules has now passed. But if you're a December year end, then this will be your first year. For March year end taxpayers, for example, the rules would have started in April. And so there'll probably be varying degrees of readiness. Although in our experience, a lot of groups have now assessed the rules and have already implemented restructuring to try and manage the implications.
Yeah, so Glenn, some of the clients were deeply involved in the consultation process and have been involved from inception. There are others, particularly those in the region, global groups, are coming to grips with it and really looking at the different choices. So it is a variance in terms of what we see in the market.
Thank you for your insights, Suki and Max. Right. Som, do we have the results?
And I can see it on my screen
Yes, please.
in
Yeah.
terms of how prepared the organisation is. So it looks like the majority, by a little bit, so about 53%, is trying to understand the rules, which probably makes sense given it's a Asia Pacific audience that we're hearing today. About 31% are currently assessing the impacts, and then another 12 or thereabouts assessed impacts, implement responses, and just a bit under 2 are ready to go. Sort of bring it on is their reaction. So that's a very
Fantastic. Thank you very much, Suki. And why don't you just take us into the details of the rules, Suki?
Sure. No, thanks, Glenn. So given we do have a wide audience today, particularly given that polling, I thought it'd be helpful to start with a general background. So we'll look at 3 questions on the current rules, the why, the who, and the what, and then use that as a framework to then compare and really contrast the new rules. So in terms of the why do we have these rules? So Australia's headline corporate tax rate is 30%. On the other hand, interest withholding tax, the rate is 10%. So the concern is that if the lender and the borrower are related, then debt can be used to convert and extract pre-operating profits, which would otherwise be taxed at 30%, into interest, which you'll see on the right-hand side, taxed at 10%. So, like many OECD countries throughout the world, Australia has rules to protect its revenue base and ensure borrowers are not too thinly capitalised. So, this gives context for the second question. That is, who do the rules apply to? So, a quick way to see if the rules applies is to ask, is there a cross-border element? So is there a cross-border element? So the rules apply in an inbound context as well as an outbound scenario as well. So by inbound scenario, there are 2 main ways. So one's a foreign-controlled Australian entity, and the second is where there's a foreign investor with Australian operations, a permanent establishment. Now, whilst there is that cross-border element, an entirely Australian borrower can also be brought into these rules if it's considered to be an associate of another entity that's subject to these rules. And so to be an associate for tax broadly means you're related in some way. This associate test is quite wide in our tax law, particularly after the BHP case a few years ago, where the Australian High Court lowered the bar of what's considered to be an associate. So for real estate investors, the main exceptions to the thin capitalization rules are really where, one, the debt deductions are relatively minor. So by that, that's less than 2 million. Or 2, it could be an Australian outbound, but most of its real estate assets are outbound, 90% threshold, and that Australian entity is not foreign controlled. There are also exceptions for insolvency remote special purpose vehicles, so securitization vehicles. So who the new rules apply to in the new world, in the new rules, is largely unchanged for real estate investors. The definition of financial entity has narrowed, but that's more relevant for banks, for financial institutions who continue to access the higher gearing ratios using the current asset-based tests. So looking at the what are the rules then? In terms of the current rules, the safe harbor debt test is really driven off the balance sheet. So it provides a 60% debt to asset ratio, and it's similar to what we're seeing in the market anyway. Similar to the loan covenant ratios that we typically see Australian senior lenders lend in the real estate space. Transfer pricing is a backstop. So it's a backstop to that 60% test. Under the current rules, the transfer pricing arm's length debt test, that can allow you to borrow above that 60% limit if you can show that that debt is arm's length. So we do see the transfer pricing test being used. It's used in highly leveraged real estate deals. So typically where there's mezzanine subordinated debt that's used on top of the primary senior debt. And also in recent years, just with declining real estate valuations in some parts, that's put pressure on the 60% test and then prompted a number of participants in the market to then look at that transfer pricing arm's length debt test. So in the new world, the new debt limitation rule, that's a profits-based test. So you see on the right-hand side, there are 3 new tests that replace the existing tests. That final one, that debt deduction creation rule, that's an integrity rule. It's a completely new rule. There's no current equivalent to that. So let's have a look at just what are these new rules. So they apply, the new debt limitation rules operate for income years beginning on or after 1 July 2023. And there are key differences between current and new rules. So looking at the fixed ratio test, that's a profits-based test, whereas the safe harbor test is assets-based. So instead of the current 60% balance sheet test, the new fixed ratio is based on a 30% of tax EBITDA. Now, many OECD countries already have an EBITDA test. So for many global real estate groups, particularly those with a footprint in Europe, a footprint in the UK, this test is not new. So Australia is really just catching up with the rest of the world. So internally, there are leverage points that you may well have within your group to use existing models, to use existing tax calculations that may be floating around, which are based on a 30% EBITDA. So the test is a default rule, no elections required. And importantly, one advantage of the fixed ratio test is that the excess, so that is debt deductions which are denied under this test, that's not a permanent difference and it can be carried forward. We'll come back to that in a minute. The group ratio test, that replaces the current worldwide gearing test. It's by election only. So that can be beneficial if your global real estate group is really highly leveraged. So it's where the global group EBITDA is greater than 30%. But really the challenge in terms of this test that we're seeing is the accounting consolidation requirements. And it may mean that this test is just practically not available for some global real estate groups. And finally, the third-party test, that replaces the current transfer pricing arm's length debt test. It's also by election. In short, third-party debt is deductible, but related party debt is not. So shareholder loans are out. So that's a big change from the current rules. So a few observations in terms of what we're seeing in the market. Some real estate groups are finding that even though historically their debt was well within the current 60% asset test, they nonetheless fail the new 30% profit-based test. And that could be because of volatility of earnings, they've got greenfield developments, etc. So there's really decisions that need to be made in terms of using each of these tests. There's pros and cons. So for example, as I mentioned, interest deductions can be carried forward under the ratio test, but not under the other methods. On the other hand, a key advantage of the third-party debt test is that all third-party debt is deductible. There's no 30% cap. So, and then looking at the group ratio test, we've probably seen less usage at this point in time. And the reason is because there are some pretty difficult accounting consolidation issues. So that's been a hurdle. And then given that related party debt is out and there are just a number of other issues which we'll talk about in the new rules, we have also seen participants looking or have restructured loans to transition to the new rules. But before any restructuring can be implemented, you do need to get comfortable that any proposed restructuring doesn't trip up that anti-avoidance rule, the new debt deduction creation rule. So let's look at the fixed ratio test, just a bit more detail. So the EBITDA is the starting point. It's a common measure of profitability throughout the world. So you do start off with the accounting concept, the accounting earnings, and then add back interest, add back tax, add back depreciation and amortization, and you get then the earnings above the line. So then the new debt test for tax purposes, it uses that as a base, but instead we use a tax version of that EBITDA, so a tax EBITDA. So the building block is taxable income. And to get taxable income above the line, we add back interest deductions, we add back depreciation and building allowance, and these are big items for real estate investment. And then we also add back adjustments, and those adjustments depend on the level of equity ownership. So equity ownership in underlying trusts, underlying partnerships, underlying companies, and I'll come back and talk a bit more about that. Then once we've got that, the tax EBITDA, 30% of that tax EBITDA is then the fixed ratio limit. That's the amount that you can deduct for tax purposes under the fixed ratio test. So then there's an excess, right? So the blue box on this screen, the excess, that's the debt deductions that are denied. So that's the amount that's above that limit. It's not a permanent difference. And as I mentioned, it can be carried forward for 15 years. And that's as long as the usual loss carry forward rules are satisfied. And importantly, also that you cannot elect into other new methods. Otherwise, the carry forward is lost. So this next slide does provide more detail in terms of the steps to calculate the fixed ratio tests. But relevantly, I want to draw your attention to step 1, step 4. Both of those steps refer to adjustments for underlying equity investments, which depend on the percentage ownership. So it's probably worthwhile just spending a little bit of time on that because there are some observations, particularly in an M&A context. So by way of background, an Australian company group with 100% subsidiary companies in Australia, they can group as a single entity, as one entity under our income tax consolidated rules. So that means that when applying the thin capitalization rules to a tax consolidated group, it's just applied as one single entity. So even if debt, even if equity is spread throughout the group very unevenly, that doesn't matter because we just do one calculation, it's consolidated. Now, on the other hand, real estate groups typically use MITs, typically use trusts, and trusts aren't able to access the income tax consolidated group. So what that means is that there is not that ability to access the grouping rule for income tax purposes. So the current thin capitalization rules do have then a quasi grouping concept, right? It allows excess debt capacity in a trust as part of a group to be used elsewhere in the trust. The new rules also have a quasi grouping rule, but there are problems, there are gaps. So you'll see on the screen here, if you have less than 10% equity ownership in a trust, partnership, a company, you can increase your tax EBITDA for distributions from those equity investments. So obviously, the higher the tax EBITDA, the higher the tax deduction limit. So you want a high tax EBITDA. Now, on the other hand, if you have 50% more equity ownership in those entities, you can also increase your tax EBITDA. And that's by flowing up the so-called excess EBITDA of the underlying entity. In other words, that excess capacity can be used. So you can see in those two scenarios, the rules are fine. They operate as intended. The problem is where you own 10% to less than 50%. That's that middle column in the black. You cannot increase your EBITDA and you cannot include the underlying distributions. So it's what we sort of loosely call the dead zone. And it's an important point, particularly in an M&A context when structuring real estate, so real estate joint ventures or co-investment agreements where there's more than two that's in there, this becomes a real issue that we've seen in the market already. Now, another point of difference between the current and new rules is the definition of debt deductions. In the new world, under the new rules, debt deductions is much broader. It includes two things. It includes an amount economically equivalent to interest, so that's probably more in line with OECD, And secondly, it no longer needs to be in relation to the debt interest. So interest rate swaps are now included in the definition. If there was any doubt before, under the new rules, there will be a wider range of costs that may be subject to denial because of the expansion of that definition. The last point that I want to raise before we look at the third-party debt test is really transfer pricing. So how does transfer pricing fit into the new rules? What's the interaction? So in short, transfer pricing has a much bigger impact in the new rules than it was before. So under the current rules, as long as the amount of the debt is within your 60% safe harbor, so it's within your 60% balance sheet, then transfer pricing can't touch you on the quantum of the debt, right? So you've calculated under the safe harbor, transfer pricing doesn't operate, but it could operate to modify the interest rate. So that's the current world. Under the new rules, transfer pricing can touch both. It can modify, it can change the amount of the loan, as well as the interest rate as well. So then the order of the application of the new rules, when we're thinking about, well, what do we do to calculate my denied deductions? Step one is really applying the transfer pricing rules, both in relation to the amount of the loan as well as the interest rate. Step two is then, well, looking at the integrity rules, the new debt deduction creation rules. Do they apply? How do they apply? And it's only as a residual, the third step is then we go, okay, we apply the new debt limitation rules. So one of some of the takeaway points at this point is, in this new world, because interest can be denied under the new debt limitation rules or transfer pricing, a transfer pricing work stream really needs to be included to work out how much interest can be deducted. So for groups who historically relied on the 60% balance sheet test and never used the transfer pricing arm's length debt test, this is completely new. Transfer pricing will now be a new work stream, and for the first time will involve documenting the arm's length nature of both the amount of the debt and also the amount of the interest rate. So in the past, it may be that just even as income tax practitioners, we just analyze safe harbor. Now, whenever we have a new debt limitation issue, we bring our transfer pricing colleagues. So the third-party debt test, we're going to go through a number of case scenarios. I'll hand over to Max.
Thank you, Suki. So turning then to the third-party debt test. So in practice for real estate investment, what we're finding is that where the level of gearing is more than, say, 25 or 30%, there's often going to be denials under the fixed ratio test, so the default test. And so given that third-party lenders are typically willing to lend up to 45, 50, 55% against the value of real property, the availability of the third-party debt test becomes really important. So while you generally expect the deduction should be available for interest on third-party loans, there are very strict requirements to meet the third-party debt test, and this can actually make it challenging to qualify in practice. And so these rules do require careful consideration. So comparing the third-party debt test to the arm's length debt test, which previously applied in Australia, they're both aimed at doing the same thing, being the prevention of inflation of interest deductions in Australia backed by non-Australian assets. But the way that they do that is very different. So under the old arm's length debt test, you could claim deductions up to the level of debt that could be supported as arm's length from a borrower and a lender perspective. And you had to ignore in that assessment any credit support that might be provided to the borrower. The arm's length debt test could be applied for both third-party loans as well as related party loans. Now, the third-party debt test is quite different. It only applies to third-party debt or certain qualifying back-to-back loans. It requires strict adherence to a set of conditions, including a strict restriction on credit support. Where the third-party debt test applies, no deductions are available for related party debt. So the third-party debt test is an elective test. If an election is made and any of the third-party debt conditions are not satisfied, though, then no deductions would be available. And so it is very important to consider whether all the conditions can be satisfied before making this election, and therefore we're going to go through the conditions in a little bit of detail. So this slide just shows the overview of the next part of the presentation. So we're going to first draw out some key concepts and go through the conditions of the third-party debt test, and then look at a few examples just to draw out and just apply those in practice. So one of the important definitions that permeates the third-party debt test rules is this concept of an obligor group. Now, the obligor group for tax purposes is not always going to be the same as the obligor group as defined in the financing documents. So the definition of the obligor group for tax purposes includes the borrower, as well as any entity where the bank has recourse for payment of the debt to its assets. For these purposes, where the only asset that the bank has recourse to are membership interests in the borrower, then the entity that holds those membership interests can be excluded from the obligor group. So just to illustrate this, we have an example where we have a third-party bank that's lending to a trust, which we've called Mid-Trust. Mid-Trust has a subsidiary, Asset Trust, which holds a real property asset, which is leased to Subco, which is a third party. Subco is owned by an offshore parent, Headco. In this case, Headco has provided a guarantee to Asset Trust in respect of the lease payments. So if we assume that the bank has recourse for payment to the membership interests in Mid-Trust, all of the assets of Mid-Trust and all of the assets of Asset Trust, then the obligor group members include Mid-Trust as the borrower, Asset Trust as an entity that is providing security over its assets, but not Head Trust. Head Trust in this example is not included because the only asset that it is providing recourse to are membership interests in the borrower. So then the first situation where the obligor group definition becomes relevant is when looking at whether the third-party debt election made by a borrower can impact on other entities. So where a borrower has made the third-party debt election, all members of the obligor group that are associate entities based on a 20% ownership threshold are also deemed to make that. Where the third-party debt election applies, then, as we talked about earlier, no debt deductions are available for related party debt or any third-party debt that doesn't meet the third-party debt conditions. So in the first example here, we have Mid-Trust, which has made the third-party debt test choice. Head Trust has provided security to the bank over the membership interest in Mid-Trust. We've got here Head Trust also owning units in another investment through Asset Trust 2, and Head Trust has funded that investment through related party loans. So in this case, Head Trust, even though it has more than 20% in Mid-Trust, is not a member of the obligor group because the only asset it is providing recourse to are the membership interests in the borrower, being Mid-Trust, and so the exception applies. And so Head Trust here can still choose to, or will default to using, rather, the fixed ratio test to deduct interest under the related party loan. The second example illustrates what is a bit of a trap, where in this case we have investors that have more than 20% being brought into the obligor group by virtue of providing security over the units in Head Trust. So because Head Trust in this example is not the borrower, you can see that it's the Asset Trust, which is the borrower, then the exception that we talked about doesn't apply. And so therefore, if Asset Trust makes the third-party debt test choice, this choice would automatically apply to the investors. And therefore, if any of the investors had interest under related party loans, that interest would be denied. So as an investor with a greater than 20% interest, it is important to make inquiries to determine firstly whether you might be brought into the obligor group, and then secondly, whether the investee intends to make this third-party debt test choice, which would impact on the investor. So turning then to the third-party debt conditions and looking at the example from previously, the first couple of conditions really just relate to the loan being from a third party. And as you expect, that would be generally satisfied for third-party loans, although you do have to be careful where there is a relationship between the investor, an institutional investor, for example, and a bank, and noting that the association requirement is only 20%. So it does still need to be considered. The third condition there is a restriction, which requires that the bank can only have recourse for payment of the debt to Australian assets that are held by the borrower, membership interests in the borrower, or Australian assets of a member of the obligor group. So again, this obligor group definition is important for this condition. Now, none of the assets that the bank has recourse to can be rights under a guarantee, a security, or other form of credit support. So unless it is a permissible kind of credit support based on a number of exceptions, which we'll cover shortly. The fourth condition is a requirement that the proceeds from issuing the debt can only fund commercial activities in connection with Australia. Now, that specifically excludes investment in a foreign permanent establishment or foreign controlled equity or debt. There's also a prohibition on third-party debt being used to fund interest-bearing debt to an associate entity. Now, this seems to be almost an embedded anti-avoidance provision to prevent recharacterisation of, for example, rental income into more concessionally taxed interest income through on-lending at a margin. Accordingly, there is an exception to this rule for on-lending on back-to-back terms, which we'll cover off a little bit later. So then, what are permissible forms of credit support? So as you'd expect, if the credit support is in relation to Australian assets of an Australian entity within the obligor group, that is permissible credit support. Credit support provided by a non-associate entity based on a 20% threshold is also permissible. Also, there is a concession that relates specifically to the development of Australian land. In this situation, it's permissible to have credit support from a non-Australian entity that is an associate entity, provided that that non-resident does not hold a 50% or greater interest. This concession only applies, though, during the development period, and so it is important to consider whether the bank continues to require credit support from an offshore associate following completion of the development. After the completion, this concession falls away. This can be the case where there is a period of time following completion for stabilization of the asset. So build-to-rent development is one example of that, or storage facilities where there tends to be leasing up ongoing after the completed. So the bank may require continuing support, and that therefore does mean this concession is no longer available after that time. So then, applying the recourse and permissible credit support requirements from earlier, we can see that recourse to the assets of mid-trust and membership interest in mid-trust held by head trust would constitute credit support to mid-trust. However, the exception that we talked about, where the credit support is assets of an Australian obligor group member, should apply. Similarly, with respect to the parent guarantee provided by HeadCo to the asset trust, that should be permissible credit support on the basis that HeadCo is not an associate entity. There is a potential question as to whether the assets of HeadCo need to be tested for these purposes, although it seems like the better is that that should not be required. It's possible that ATO guidance will be issued on this issue to consider exactly the extent to which such indirect recourse needs to be considered. So we'll turn to another example.
Hi, Max. Apologies to interrupt. There seems to be some network issues. I wonder if it might help if you turn off the camera for now and see whether your voice can be better picked up. Thank you.
Thank you. So let me know if that continues. So in this example, we have two investors investing 50-50 into a trust structure in Australia with a bank lending to the asset trust. One of the 50% investors is offshore and the other one is local Australian. And each investor is providing a guarantee directly to the bank. In this scenario, the recourse requirement would be failed because the bank has recourse under the investor guarantee to assets of a non-Australian entity in the obligor group. Where the local investor had non-Australian assets, this would also be problematic. In the next example, investors are providing rights under an equity commitment deed in respect of a real estate development project in Australia. The bank has recourse to the rights to call on the equity commitment from the head trust and from each of the investors. The rights under the equity commitment deed in this case should be permissible credit support, even though they provide indirect recourse to the assets of a non-Australian entity, because the development concession should apply here, noting that in this case, the offshore investor does not hold a 50% or greater interest. So as I flagged earlier, there are concessions for back-to-back loans, and this is referred to as the conduit financer modification. I think if we can just flip it to the next slide, please. And sorry, the next slide. Thank you. If we can move to the next slide, please. Slide 36. So as I flagged earlier, there are concessions for back-to-back loans. And this sort of structure where we have a financing company established within the Australian group, which raises money in the debt markets, sometimes through a public offer or through a syndicated facility under the Australian Section 128F withholding tax exemption, and the FinCo then on-lends to other entities in the group. In this situation, because the loan from the FinCo to the asset trust is a related party loan, it would not normally satisfy the third-party debt conditions. To accommodate these kinds of structures, the conduit financer modification can treat the related party loan as if it were a third-party loan, where the third-party loan is on-lent to a related party on the same terms as the third-party loan. In order to access the conduit financer modification, there are two key requirements. The first is that the related party loan is funded only from the proceeds of the third-party loan. This seems to require a tracing of the funds to show that the third-party loan has been on-lent in whole or in part to the related party. For a new financing arrangement that's entered into today, it might be possible to evidence that through accounting journals or through other records. However, what we're finding in practice is that for historical arrangements, these types of records are not necessarily kept. And so being able to show strictly that the related party loans were funded only from proceeds of the third party loan is something that can be quite difficult, if not impossible, to do. So these sort of practical issues are coming up for our clients at the moment, and you get additional tracing complexities where you have third party loans that are repaid without related party loans also being repaid. So, for example, a refinancing occurring. The next requirement is that the on-lending is on the same terms as the third-party loan. This requires that the interest rate for each related party loan is the same as the relevant third-party loan. This can be problematic where the FinCo may have a number of third-party loans, but may on-lend under a single related party loan with a blended interest rate that is back-to-back in an aggregate sense, but each related party loan is not back-to-back with a particular third-party loan. We also see cases where the related party loan includes a recovery of costs, such that the FinCo maintains a break-even position. The rules permit recovery of reasonable administrative expenses in respect of the third-party loan. However, it's not clear whether this would include administrative expenses relating to FinCo itself, for example, directors' fees or audit and tax fees. So those kind of recovery arrangements can be problematic in terms of satisfying the conditions. So again, for existing arrangements, in practice, the conduit financier requirements can be very difficult to satisfy. So turning now to the new debt deduction creation rule. So this is a new anti-avoidance provision which applies for income years starting on or after 1 July 2024. But with no grandfathering, they can apply to transactions entered into at any time in the past. The rule is targeted at transactions that push additional debt into the Australian group. To the extent the debt deduction creation rule applies, no debt deductions are available for the related party loan. The debt deduction creation rule broadly has two limbs. The first is where there is an acquisition of an asset from an associate that is funded with related party debt. The second is where there is a related party debt that has been used to fund or to facilitate the funding of a capital or revenue distribution made to a related party. Now, there's no purpose test built into this anti-avoidance rule, so simply factually satisfying these requirements means that interest deductions will be denied. It's also irrelevant whether the related party loan is cross-border or whether the offending arrangement results in an overall increase in the level of debt in Australia. The debt deduction creation rule can only apply where the fixed ratio test or group ratio test is being used. This is because, or in recognition of the fact, that under the third-party debt test, related party debt deductions are in any event denied. So there are some exclusions that apply for the asset acquisition limb, which essentially allows you to borrow from a related party to set up a new company or a new trust or to on-lend to a related party. So that doesn't get you caught up in the rules necessarily. There's also a concession for borrowing from a related party to acquire tangible depreciating assets, but there's no concession that applies for acquiring trading stock from a related party. The second limb of the deduction creation rule is activated for related party borrowings to fund or facilitate the funding of various payments or distributions that are listed there. It can also include a related party loan that refinances another related party loan that was subject to the debt deduction creation rule. So in other words, if you set up a new loan to try and refresh the related party loan, then that will also get caught up. If that wasn't enough, there's a further anti-avoidance rule within the debt deduction creation rule. So even if you don't meet the conditions, if you do something else, and the principal purpose of that is to avoid the application of the debt deduction creation rule, then this other anti-avoidance rule can pull you in. So needless to say, in practice, assessing all related party loans to identify how the money was used in the past is a very onerous exercise and really often impossible to evidence. We're currently waiting for some guidance from the Australian Taxation Office here in terms of how they'll approach that evidentiary requirement in practice. Turning then to some closing remarks as well as some next steps. The first step for a lot of groups is typically to model the application of the default fixed ratio test, historically at least, to forecast the extent to which there might be denials in respect of related party loans or third party loans. Where there would be no denial of debt deductions for third-party loans under the fixed ratio test, the third-party debt conditions need to be assessed. In either case, restructuring or refinancing should be considered in order to fall within the fixed ratio limit or to meet the third-party debt conditions. In some cases, this could even include engaging with third-party lenders around recourse arrangements that exist. We are expecting the ATO to issue some guidance as to how it will assess the risks associated with any restructuring, and this is going to need to be monitored going forward. So additionally, as an investor in a third-party managed fund, the potential for the deemed third-party debt choice is something that needs to be investigated, and that can require engagement with the fund manager. And then finally, the debt deduction creation rule needs to be considered both for historical as well as for future transactions, including evidencing historical use of funds as a practical matter. Where there is actual or potential denials, then again, restructuring could be considered, conscious of forthcoming ATO guidance that we're expecting. I think it's back to you, Clem.
Thank you very much, Max and Suki. That brings us to the end of your sharing. A number of questions have come through the Q&A box, and please continue to send that through. There is a fundamental question that came through on shareholder debt, Suki, and I'm just trying to bring up that box as I speak.
Yeah, sure. Do you want to read it? I've got it in front of me.
Yes, yeah. Let me just bring it up. So I thought that's quite fundamental, and so I thought of addressing it as a first question, and that is, yeah. Here we go. What is the definition of related party? Is it a case of where there is a common ownership of 20% or more between the lender and borrower?
Yeah, no, that's a good question. So when I refer to the associate, I was talking in the context of do the thin capitalization rules apply to you? And so in that context, we use the concept of associate, and relevantly, the test of what is an associate there is really, it looks at is there majority voting interest. So typically you're looking at 50% or more. But then there's also a non-quantitative test as well. That is, even if it's not 50%, do you have sufficient influence? So you can sort of see that even below that, you can still come in via sufficient influence. And another way that you can be related is where there's a common control in terms of borrower and lender up the chain. So that's in terms of do the thin capitalization rules apply? But we would have heard in the course of this seminar that the concept of associate is then used in different parts of our debt limitation new rules. So for example, Max had referred to the third-party debt election, where if all members of the obligor group that are associate entities, and relevantly that are associate entities based on a 20% ownership threshold. So just important there, Clan, just to note that it depends on which purpose that we're looking at. But for the purpose of do the thin cap rules apply, do the new debt limitation rules apply, that's the general test of an associate.
Thank you. That's really helpful. I think we do have quite a bit of time to go through the other questions. We will alternate the questions for both Suki and Max to take turns to answer. So on to you now, Max. The next question is around, with so much uncertainty in the application of the third-party debt test rules, how are fund managers approaching the 30th of June 2024 distribution statements?
So, yeah, unfortunately, fund managers do need to take a position despite the lack of ATO guidance at the moment. And sometimes this does require the managers to consult with large investors to discuss the risks of taking positions when it comes to meeting the third-party debt conditions. The final third-party debt condition election, though, doesn't need to be made until the due date for the lodgement of the tax return. which for 30 June 2024 is January at the next year at the earliest. And so there is a bit of time between now and then to see whether we do have some guidance on some of these interpretive issues. Absent guidance, if we do get to the point where you do need to make an election in your tax return, there is the capacity for the tax office to allow an election to be changed after lodgement through a discretion in the law. And you'd really hope that where the ATO guidance isn't available at the time that you need to lodge the return, that the ATO would exercise this discretion to allow additional time to change the election.
Thank you, Max. Next question to Suki. Will a transfer pricing study now be needed for all cross-border loans?
Yes, I sort of referred to under this new world, the transfer pricing can impact both the amount of the loan and it can also impact on the interest rate. So under the old world, it could impact interest rate, but now it's the amount. So even if I use the fixed ratio test and I'm within the fixed ratio limits, that does not mean that transfer pricing cannot step in terms of those rules to modify the amount of the debt. So hence for that reason, we do see in this new world that transfer pricing will be part and parcel with a documentation that's done to document both the arm's length nature of the quantum of the debt as well as the interest rate. So there's a big change for a number of real estate groups.
Okay, great. Back to you, Max. The next question asks whether you are aware how long would it take for the ATO to issue its guidance materials?
Yes, good question. The ATO has committed to providing guidance on certain high priority issues, and these have been identified as including the ATO's approach to restructures and whether they'll apply anti-avoidance rules. I suppose the risk of anti-avoidance rules applying to different types of restructures in response to these new rules. Also some guidance on the third-party debt test and the conditions, although the conduit finance and modification is not included as part of that in terms of the high priority issues anyway, as well as practical guidance on interaction between thin cap and transfer pricing. They're sort of the three high priority issues the ATO has come out with. And these sort of identification of issues has come through from a consultation process the ATO went through, where they did ask for input into areas where guidance would be important. There was a lot of issues that came through in that process. The ATO has listed a number of other non-high priority issues. They've got even I think there's around 14 other issues on their website. And a number of those were the ones that we've discussed today in the webinar. Those non-priority issues will be addressed after the priority issues, so that could still be some way down the track. There's no published time frame for the release of guidance materials, but even in respect of the high priority issues, I think we're probably many months away from getting something from the ATO.
Thank you. Back to you, Suki. The next question asks, does interest withholding tax apply to interest that is non-deductible because of the interest limitation rules?
Yeah, so it's a different part of the tax act. In short, it still applies. It's a different part of the tax act in terms of our interest withholding tax. So the interest withholding tax really just looks at, do you have interest and have you paid or credited that interest? So it doesn't quite look at whether or not you've made that deduction, apart from one scenario. So so then in terms of the withholding tax as a step one, as long as you pay or credit interest, then that will trigger the withholding tax. The tax deduction is a separate issue. We've always had a backstop, that is, you can't actually take a deduction for interest withholding tax until you've remitted, that part. So so it's not a great outcome, I realise.
Thank you. We have a couple more questions coming in. Over to you, Max. Is there any scope for further amendments to the rules in your view?
Yeah, so it's been quite an interesting process. So these rules first came out in draft at the sort of beginning of last year, and then there was a consultation process, and there was a lot of changes that were made through the consultation process. I think it's fair to say that the earlier drafts of these rules were quite deficient in a lot of respects, and so there was a lot of focus on fundamental fixes to the rules. But I think that did leave us in a state where even the final status of the rules is suboptimal in a lot of cases, and for groups where that are impacted, it's it's a tax cost or tax leakage as a result. So there are certainly still scope for improvement of the rules, I would say, within the policy that they're intending to implement. So because of the consultation process and all of the issues that were raised, there was actually baked into the law a requirement to consult again on these changes through an independent review, which would include a public consultation process. That review has to begin by the 1st of February 2026 at the latest, and so that's potentially still a long way away. As we continue to identify technical issues and practical issues, to the extent that the ATO guidance doesn't help us once we get it, then we'd expect those issues to be raised through this process, and that could result in some amendments, but that
I'm not sure if it's just me, but I don't hear Max anymore. Suki, would you like to take the next question?
Sure.
Okay, thank you. So there is a question about whether Deloitte sees fixed ratio method generally being more preferred by most companies rather than third-party method due to the ability to carry forward excess interest.
Yeah, I must admit, when I first started that process, I thought maybe that would be the case as a real advantage. But there's been quite a number of occasions where we actually, the starting point is actually a third-party debt test, and the reason for that is because as long as you can ensure that the debt, that all of it is financed from third parties, there's no limit, there's no cap in terms of the deductibility. So that's the starting point. Now, obviously, there are certain real estate groups where there's internal debt, that is, it's not actually ultimately backed externally. That's a different situation. But we often do see that a starting point is, can I get all of the interest deductible? And hence the third-party debt test is then navigated. The fixed ratio test is, on the other hand, for a number of other clients, the default test, because it's just easy to use. Glenn, as the question there is a carry forward period, and so for some, they do see that as the test, which is the easiest to apply.
Thank you. In this final minute, I think that's unfortunately all the time that we have. There are more questions that we are very happy to deal with and discuss with you after this webinar. As a sneak preview into our next real estate tax geography webinar, we We'd like to update you on foreign investments into the Australia build-to-rent rules and how it interacts with the MIT, which is very topical. Thank you, Suki and Max, and special thanks to all of you who were able to join us. We'd like to encourage you to fill out the short survey that will pop up your screen momentarily and tell us what you think about today's program. If you join us late, please note that this presentation will be archived for future viewing. If you feel that others would benefit from this webcast, please share the webcast via the share this icon or have them visit Debrief's website. We will respond to all questions, as I say, submitted during the webcast in the next few weeks. Also, if you think of any other questions or comments later, please feel free to reach out to any of us. We'll be more than happy to speak. At last, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax webcast today. From whichever country you have joined us, have a great day and goodbye for now.